You hear the term thrown around all the time, right? It's always whispered in these stories of insane wealth and sometimes spectacular collapses. But what is a hedge fund, really? It kind of feels like this secret club with its own private set of rules. Well, today we're going to crack that code together.
So, let's just start with a little bit of a puzzle. What do billionaires, that amazing movie The Big Short, and yeah, major market meltdowns all have in common? Turns out, the answer is a single, super powerful, and honestly often misunderstood financial machine.
That's right, hedge funds. These things operate in the shadows of our global economy, and they're pulling levers that can create fortunes out of thin air or trigger absolute chaos. So today, we are pulling back the curtain to see exactly how this whole thing works.
Yeah, for most of us, a hedge fund just feels like a black box, right? It's this mystery box for the ultra-wealthy. You hear about them in the news, but what is actually happening inside? Come on, let's start by unpacking the basics.
All right, so what are these things officially? At its very core, a hedge fund is an investment partnership. You have investors, they're called the limited partners. They pool all their money together, and then they hand it over to a manager, the general partner, who gets to call all the shots. But the key phrase here, the one you got to remember, is lightly regulated. That gives them an incredible amount of freedom to operate outside the really strict rules that govern most other investments you and I know about.
You know, the best way to get this is to compare it to something you might already be familiar with, a mutual fund. Just think of mutual funds like the public swimming pool. They're heavily regulated, pretty safe, and open to everybody. Hedge funds? Nope. They're the exclusive members-only country club. And that lack of regulation lets them use way more aggressive strategies and, here's the kicker, charge performance fees. They literally take a cut of the profits they make for you.
And that brings us to the velvet rope at the front door. See, all this freedom from regulation, it comes at a price. Not just anyone can waltz in and invest. So, welcome to the Accredited Investors Club.
So what's the price of admission to this club? Well, it starts right here, $1 million. That's the minimum net worth you gotta have, and that's not even counting the value of your main home.
But hold on, $1 million net worth isn't the only way in the door. You can also get in with a high income. We're talking over $200,000 a year, or $300,000 if you're married. And lately, the rules have even expanded to include financial pros with certain licenses. Now, the thinking behind all this is that regulators want to make sure investors are sophisticated enough to understand and, frankly, handle the pretty unique risks involved.
Okay, so you made it. You're in the club. Now for the really fun part. What do these funds actually do with all that cash? Let's take a peek inside their secret playbook. Hedge funds have three main tools that most other funds just can't touch. First, there's short selling. That's betting against a company's stock, so you actually make money if the price goes down. Second, leverage. This is a big one. It means investing with borrowed money to pump up your returns, which of course also pumps up the risk. And finally, there's something one author calls the buffet line. This incredible flexibility to invest in pretty much anything. We're talking stocks, bonds, private companies, currencies, commodities, you name it. So why? Why all the complexity? Why use all these risky tools? Well, it's all in the pursuit of one thing. Alpha. Alpha is the holy grail of investing. See, it's not just the return you get because the whole market went up. No. It's the extra return, the secret sauce that's supposedly generated by the manager's unique genius. That's what investors are paying those huge fees for.
Here's the difference in a nutshell. Beta, that's the return you get just for being in the market. You buy an S&P 500 index fund, boom, you've got beta. Alpha is the extra value. It's the performance that is supposed to come from the manager's skill, their magic touch. And let's be crystal clear, you are paying them those massive fees for alpha, not beta.
Man, that promise of alpha sounds incredible, doesn't it? But as you probably guessed, it comes at a seriously steep price. So let's talk about the real price of that performance.
The classic fee structure is called 2 in 20. So let's break down what that actually means for your money. Imagine you invest $1 million, and the fund has a great year. It gains 20%. First off, the manager takes a 2% management fee. That's $20,000 just for showing up. Then, they take a 20% performance fee on your $200,000 profit. That's another $40,000. So, yeah, your 20% gain just cost you 60 grand in fees.
Now, you might be wondering, what happens if the fund loses money one year? Well, to protect investors, most funds have something called a high watermark. All this means is the manager can't charge a performance fee again until the fund's value gets back past its previous peak.
They don't get paid for just making back the money you lost.
So let's just recap the trade-offs for an investor. First, you're paying those super high 2 and 20 fees. Second, you're dealing with lockup periods. This means your money isn't liquid. You can't just pull it out whenever you want. It could be locked up for years. The high water mark offers a little bit of protection, sure, but make no mistake, this is a long-term game.
All of this, the light regulation, the complex strategies, the high fees, it all places a massive responsibility squarely on the shoulders of the investor. And this brings us to our final and maybe the most critical point, the due diligence burden.
Look, you cannot rely on the SEC to check these funds out for you. You have to do the homework yourself. And this quote from our source material says it all. Do run from a hedge fund manager who won't answer questions. And you know who is famous for refusing to do that? Bernie Madoff. His refusal to explain his strategy was a gigantic red flag.
What this means is you basically have to become an investigator. You need to ask really tough questions about their strategy and exactly how they manage risk. But it goes deeper than that. You have to ask about their core operations. Who's their auditor? Who's their prime broker? That's the bank that handles all their trades. And you can't just take their word for it. You have to verify everything on your own. With hedge funds, the burden of proof is on you, not the regulators.
And that brings us right back to the central question, doesn't it? A hedge fund offers this tantalizing promise. You get access to these unique strategies, this potential for a manager's skill to actually beat the market. But it demands high fees, it demands you lock up your money, and it demands a heavy burden of homework from you. So for those who can actually get past that velvet rope, is the hunt for alpha truly worth the price of admission? Well, that's the multi-million-dollar question.